Hello and welcome to BQ Prime. You're joining us on this special broadcast where we are discussing Fitch Ratings' recent report on the Indian banking sector. Now, earlier today, the report suggested that the economic risks that came from the COVID-19 pandemic seem to be receding, and the Indian banking system is on a better footing with strengthened is the word that Fitch Ratings used. We have with us Mr. Saswata Guha from Fitch Ratings. Welcome, Saswata, to this conversation. I want to start firstly with this question of the economic risks receding, that came from COVID. I just wanted to get a sense of what are you reading in terms of what were the risks before and how have they receded now?
Hi, hello, Vishwanath, and thanks for having me. I think what we are, one of the key pillars of our assessment of the operating environment for banks is, of course, economic growth and business activity. And it is really from that, perspective one should look at it, because compared to COVID, of course, overall business economic activity has picked up quite significantly. I think even in terms of sentiment, consumer and the business sentiment, I think they are still on the continue to be on the upswing. Of course, what is important to note is that all of this has happened while inflation and interest rates have been going up. And I think in some sense, yes, you could argue that there is a level or a degree of pent-up demand which is sort of factored in. But I think in general, to a certain extent, it is also reflecting the relative resilience of the broad economy. And I think it is really from that standpoint is where we are coming from. But I think what is also accompanying this is that the financial sector per se, in our view, has become less of an impediment to economic growth. And that is simply because one, of course, is overall financials have improved, coming from their lows or highs, depending on which variable you're referring to. Highs, of course, when you talk about asset quality, but lows in terms of buffers. But what that has done is, of course, given the sector the ability to grow. So there's clearly a renewed appetite for growth, which of course is sort of getting support from this this exuberance that we are seeing. But I think, mind you, it's sort of not a chicken and egg. There is obviously an interplay, when it comes to banks and the economy, particularly with respect to India. And that is because, bulk of the credit intermediation is being done by banks. So, as long as banks are able to lend, of course, that sort of feeds back into the economy, and then you have this so-called multiplier effect. So I think in summary, I think that is broadly the two pillars on which we are sort of coming out with this assessment.
Okay, I want to pick up on this the risk factors here. Firstly, one that you mentioned is the delayed sort of legal proceedings that happen in this country, especially with regard to IBC and the resolutions there. And there's also entities created like the Bad Bank, which have not really played that much of a meaningful role as far as resolution is concerned. So till this resolution risk sort of keeps hanging, what is this growth exactly leading?
Yeah, good question, Vishwanath. So I think, and it's actually one of the structural, a major structural issue with respect to the banking system, because as we have seen, because of the issues around timely recovery of bad loans, there's been immense destruction in terms of time value of recovery, right? Yeah. Of course, banks have been writing off bad assets persistently over the last many years, in some cases which they sort of tend to refer to it as some kind of a war chest. But honestly, if you look at it, I mean, recovery from a written off account in the best of days is probably about 5 to 10%. So, and the fact that lot of these loans have been written off, in some sense, is a reflection of the fact that there continues to be a major issue when it comes to recovery. I would not like to undermine the initiatives that have been put in place, but our point is that those initiatives have not necessarily worked in the manner that they were expected to work. So what does that really mean in terms of fresh loans? What that really means is that as risk appetite grows and the appetite, and we will progressively see that growth, that sort of appetite as and when the economic growth, continues to sustain. So today we are seeing that in retail. Slowly we are seeing emerging signs in corporate and SME, and I think that that momentum will only increase, subject to overall business and consumer sentiment. But I think most importantly, what, in light of the fact that we have our overall recovery framework is not up to, or hasn't really been able to work in the manner we had anticipated. What that really means is that underwriting standards have to be solid, because the ability to run a bad loan and then recover is arguably very challenging here in India. Of course, I would have to sort of make sort of put in a caveat here, is that while we are talking about recovery as a very sort of broad class, clearly different asset classes behave differently when it comes to recovery. So, for example, a retail loan, a secured retail loan, recovery is arguably going to be a lot better and faster, as opposed to, say, an unsecured retail loan where recovery potential is almost nil to negligible, or for that matter, a corporate loan where there might be recovery potential, but because of litigation, as we just discussed,
Right.
that potential diminishes over a period of time. So our view is that, and this has sort of been our biggest contention, and also one of the factors that constrains a lot of the standalone ratings on banks that we have, which is the risk profile, that irrespective of the improvement in the financials, we do believe that it does not necessarily signify an improvement in the risk profile, for a simple reason that the risks that have been underwritten in the last, or in recent years, may not have not really been put to the test. So we have not really seen a through the cycle good performance. And we all know how the past through the cycle performance has been, which is very, very volatile. So I think our sort of cautionary note, if you could call it, that essentially stems from that philosophy.
Okay. I want to touch upon this a little bit more, especially with regard to retail. Now, yes, there has been better recovery potential as far as secured retail is concerned. But over the last 3 or 4 years, well, not 4 years, actually, the last 3 years, ever since the difficult part of COVID got over, you've seen this resurgence in unsecured lending, and that sort of is pushing a lot of bank credit up. I'm curious to understand when we're talking about banking sector growth and we look at the unsecured portfolio, does that make you nervous at all?
Well, it does, right? I mean, if you look at credit cards and personal loans together, that's roughly about 10.5 to 11% of the system as of March 2023. Of course, credit cards is still a very small share at about 1.5%, maybe 1.5 to 2. And the rest of it is largely personal loans. You're right. I mean, if you look at retail as a broad asset class, I think retail, it's not just the last 3 years. I think retail in general has been growing well above the system growth. But what has been interesting is that until maybe 2022, a lot of the emphasis was on the secured classes. A home loan had and in some sense, you could argue that home loan still continues to be the driver because it's over 50% of the total pool.
Correct.
But having said that, I think 2022 was when we saw a sharp spike in the unsecured personal loans, which of course sort of that momentum only increased in the financial year 2023, which also sort of had higher interest rates and so on and so forth. So our sense is that part of that is probably led by the desire to insulate one's margins. I think banks, because obviously they were feeling some heat on the funding cost side, and as a result, to offset that, they started lending unsecured more aggressively as they were. And I think the challenge with growth, always particularly fast, aggressive growth, is that if it sustains over a period of time, it opens room for misjudgments and mispricing. Because let's be clear that the market as it is intensely competitive.
Right.
And we all know that the large private banks in general, but the large private banks are not just long-time players in this space, but also are very, very aggressive when it comes to retail loans in general, but also credit cards and personal loans. And so if you're competing against that kind of a competitor, the question is that, and you continue to grow at 25, 30, 40%. In some cases, banks have doubled their books year on year. Then the question is that, one, are we necessarily underwriting the right kind of credit? And if we are, so which is the argument by many banks that, we still are largely catering to existing customers, then the question is, are you pricing them appropriately? And I think this is a concern that we have. I do not yet feel it is a systemic risk. But yes, I think, some of RBI's more pointed statements on this, I think, would hopefully ensure that it doesn't become a systemic risk either. But it is a risk nonetheless, because this is an observation that, we have been having for quite some time.
Okay. One of the points that you mentioned in your report is also the formalization of the SME sector, and that will eventually aid the banking system. The point of rationalization has been going on for a while. So GST itself is over 6 years old now. I'm trying to understand whether formalization as a promise is meeting the potential that it promised.
Yeah, I mean, that's a difficult one, really. When we of course speak with market constituents, you do generally hear a lot of positive feedback, sentiment around it, and there's a certain coherence in those responses. So I would assume that perhaps it's not all smoke screen. So there is really some action on the ground. But I think SME as a sector is also a very risky sector. Sure, you make your margins, but the potential of losses is also very high. And as a result, and given the stress that the sector had particularly seen during the pandemic and even before that, banks have been quite cautious when it comes to this sector. I think to put an industry sort of figure out there, what we sort of anecdotally I registered recently is that if you look at the breakup of banks and NBFCs actually catering to the requirements of the SME sector, there's a disproportionate share that is being shouldered by the NBFCs. Banks are probably shouldering about 20-25% of the total requirements of the sector. So what I'm trying to say here is that what banks are underwriting is still very cautious risk. I think they are probably cherry picking because they can, and sort of trying to address and cater to those SMEs where they see some of those sort of risks relatively mitigated. I mean, an SME can never be free of risk, but I think they do have a lot of exposure indirectly via lending to the NBFCs, and that holds true for even unsecured personal loans. And because while banks are not giving out the small ticket SMEs necessarily in very aggressively or personal loans very aggressively, the small ticket ones, NBFCs are doing that because that is a market that banks are not catering to. And therefore, there is this so-called bundled risk that is there. And if you look at the exposure of banks to SMEs, that has gone up by a significant proportion. So there is that other risk as well, which is sort of indirectly playing into the book.
Okay. I want to close this off with the most interesting point that I thought was with regard to the demographic position, favorable demographic position of the Indian economy, as well as the size, of course. Now we're talking about a fast-growing economy. The government sort of target is to have to become the third largest within the next 5 years or so. If you are going to base your growth on the domestic demand scenario, and there again there's differences between how fast the urban demand is growing versus the rural demand is growing, but if you're just going to base it on that, and you're going to be sort of pushing past a lot of other economies into becoming even larger than you are today, I just wanted to have the opportunities versus the risks sort of an assessment in your mind. What will work for the banking sector and what probably they should be a little more careful about?
Yeah, again, I think, good you asked. See, one is to understand that in India, as I said, I mean, the expression they often use is the economy and the banks are joined at the hips. You can't have one without the other.
Yeah.
And we've sort of seen that play out for a good part of nearly a decade. So banks have to contribute if the economy has to grow. And banks are in the business of risk taking, so they will take those risks. The question is, one, how they are taking those risks. So we talked about competition, we talked about pricing, we talked about aggression. All that is sort of bundled in the whole principle of underwriting and risk monitoring. But the other side is tolerance, right? So it is very hard to predict cycles, but cycles do happen, right? So what we are seeing today at some point will turn. It's not the question of if, it's a question of when. And we do not know how then those risks will manifest. And what is therefore important for us as credit analysts is to see the relative tolerance of the system. Now, averages sometimes can be misleading because they tend to bundle both the best of the class as well as the worst of the class. But having said that, I think since it is the public sector banks will still account for more than 60% of the sector assets, and arguably will continue to play a prominent role in the system.
Yeah.
I think from that perspective, we still feel that tolerance, while improved, is not necessarily adequate for the kind of risks that banks are taking. See, in India, risks are not very asymmetric, right? Particularly the risks that banks are chasing. At a per capita level, we may be maybe $2,500, but the kind of customers that banks are catering to, they have a per capita income which is much higher, right? And everybody's sort of chasing that sort of asset class.
Correct.
Which then comes that if somebody has to compete on the basis, irrespective of the competition, and may have to sort of extend or give in some room in terms of pricing, then do they have the necessary buffer or wherewithal, say on the balance sheet side, to be able to withstand those risks if they were to manifest? And that is where equity comes into play. Because of the pricing challenges, we think that at the income level, the buffers can only be so much. And we have sort of seen that vanish at the drop of a hat when you build even slightest concentration risk, and that goes back. So I think while buffers really have improved, but it is the capital side which I think is still sort of not up to par as we see with say banks, similar banks in the region. And I think that's where we do feel a bit bit less comfortable when we sort of talk about Indian banks in general, but also state banks in particular.
All right. Thank you so much, Saswata, for joining us on this conversation. Pleasure talking to you.
Thanks, Vishwanath. Nice to meet you.